So the agenda today, it's mostly going to be around Frank, and of course we want to have a lot of time for Q&A. It's a very critical topic, and we want to make sure that we can get feedback and comments and questions from the audience. I'll start very briefly by introducing Agendi, also explaining some of the work we do around transition planning, which is what we think corporations should do in order to be ready for the next financial crisis, which we think might be triggered by the climate crisis. And then introduce Frank, and Frank will walk you through the historical context for the current infrastructure that we have when it comes to managing the financial system at a global level. He will provide some of the current context of the climate crisis and the links that we see in the financial system. And then he will share some reflection as we prepare for COP28 in Abu Dhabi later this year. So very briefly, Agendi, we are a climate and sustainability consulting firm. We mostly work with large organizations, both in North America and Europe. That's really where we have our focus. We started 7 years ago, back in 2016. Myself, I'm the founder and CEO. I've been working for almost 20 years in ESG, mostly climate, but more recently, more and more on other aspects. Of course, you cannot work in a silo, and we need to look at other environmental risk. We see biodiversity as being a very critical risk that is impacting our clients and their supply chain. We also think that governance is often used, so we are working more and more with clients on broader ESG issues, including things such as materiality assessment, which are becoming critical with recent EU legislation. So we'll be discussing later, I think, on corporate sustainability, due diligence directive, and CSRD, corporate sustainability reporting directive. Agendi, we are a team of 35 consultants. So as I said, mostly North America, UK, and expanding to Brussels and Paris this fall. We are a B Corp certified organization. We are a CDP accredited provider. We support dozens of organizations respond to the CDP and make progress thanks to the CDP platform, building the governance, the targets, and making sure that they provide metrics that are needed for the investors. We set our own science-based targets, but most importantly, we have also dozens of large organizations setting their own science-based targets. We are also active in the renewable energy market. We are green certified provider of RECs in the US, and we also provide other types of energy attribute certificates, and we are also silver rated with EcoVadis. In terms of the services that we offer, we are a full service offering climate and sustainability consulting firm. We do a lot of work on knowledge and capacity building. The work that we do is evolving rapidly. There are new legislation in the US. We are waiting for the SEC proposed rule on climate disclosure to be released very soon. So we receive a lot of requests from our clients to train the financial team, the finance function, but also we work a lot with procurement in making sure that they understand the implication of the sustainability risk that we help our clients understand and mitigate. Understanding the impact is still our core services, so we do a lot of work around greenhouse gas inventories, but also other environmental aspects, so looking at water usage or biodiversity or even waste or plastics use. We help in setting the strategy for us that involve things such as conducting materiality assessment, setting reduction targets, typically working with the Science-Based Target Initiative, designing credible transition plan, which will be what I will be discussing on the next couple of slides, and also helping our clients when they face key strategic issues or reorganization. So we do a lot of work around M&A when we have clients that make acquisition or divest, looking at the impact it might have on their own targets. The last two buckets of our services are enabling action. So we support our clients in implementing the recommendation that we provide, whether it's around renewable energy or supplier engagement or building net zero strategy. we want to be there to help them. And that's not just us at Agendi, it's really leveraging our own network, working with service providers that can help our clients achieve any goals they set when it comes to ESG and climate. And lastly, but not least, of course, reporting and disclosure. A lot of the demand for services is coming from the fact that many of the frameworks that have been around for sometimes 20 plus years are voluntary, but are being embedded into regulation. So that of course creates a lot of interest, not only from the finance function, but also from legal and operation, as what we do today is mandatory for many of our clients. So we need to make sure that we offer the best quality to help them navigate through this new landscape. We work across all types of industries. So we have industrial clients, we have a services company, financial institution, high-tech companies, insurers, academia. Our core business is really sustainability, but we have more than 100 clients and support any type of business that is willing to change and adapt to the climate crisis. So before letting Frank give his keynote address, I want to explain a little bit what we have been doing over the last 12 months working with our clients setting transition plans. Some of you might know this is becoming extremely important for different reasons, but one of them, which is quite pragmatic, but still important for companies that do care about their CDP score. If you want to be on the CDP A list, which can be important for your investors and for your other ESG ratings, you know that MSCI and DJSI typically look at the CDP score as well as a proxy for the climate ambition of a corporation. It's required today to have a transition plan that is aligned with a 1.5-degree trajectory. So what do we mean by transition plan? Basically, it's a plan that outlines an organization strategy to prepare for a low carbon economy. So of course, it needs to include things such as the targets that you set, but it needs to be much more detailed than just disclosing your science-based targets, even if it was validated by the SBTi. You also need to be transparent about how you are going to finance those, how you are going to finance the different activities that you will need to put in place in order to achieve your targets. You need to be very specific about the type of initiatives and also most importantly about the governance and accountability mechanism that you will have in place to make sure that you meet your targets. So I think for those of us who have been working in that space for basically since 2015, the Science-Based Target Initiative was launched as a pilot just before the Paris COP in 2015. We know that sometimes companies are setting targets and they don't know exactly how they will meet those targets. They do it for different reasons. Reputational pressure from their peers, from the investors, but we will try that every company that have set targets have a clear plan that they can follow and all the accountability mechanisms in place. So how do we, I think what's important in any transition plan is to make sure that we address stakeholder expectation. So stakeholders, it can of course be the clients, it can be the investors, it can also be other employees. We know that one of the reasons why many corporations are setting ambitious climate goals is sometimes to retain and attract talent. But of course, you are not going to retain and attract talent if you only have a very bold objective, but have no plan to achieve it. So it's critical to make sure that you understand all those stakeholders and their need and how to communicate clearly about the direction that you want to give your business. It's of course to facilitate risk management. What we see in our work, and I think what really changed over the last 2-3 years is that while sustainability teams often work in silo, I would say, and were sometimes disconnected from the finance function and the risk management function, today we see that the demand for climate risk analysis come from the finance function and the risk management. So making sure that we can work together with risk professionals, identify climate-related risks, not just physical, but also transition risks. So, and you'll see that there are many transition risks that can impact most businesses today. So even if you are in an industry that has a really small carbon footprint, we can think of the tech industry, for instance. Once we start looking at the transition risk, we see that it's material for virtually any business. I mentioned it already, meeting some of the voluntary reporting rating systems, so CDP being one of them. Probably not the main reason why companies should do transition plans, but that's I would say that's the icing on the cake. Get ahead of regulatory compliance. It's already mandatory in the UK, but of course with the EU CSRD, having a robust transition plan will be needed and required as well. Last but not least, of course, reputation and brand alignment. The way we address this with our clients is through a 6-step approach where we typically start with a gap analysis. So what we do, and because we support many of our clients on their CDP response, we have a good understanding of where they stand when it comes to governance, risk, and their metrics. So it's really conducting a gap analysis to see what's missing to have a robust action plan and transition plan. We can also assess the maturity of the overall strategy, and we do some benchmark also against some of their peers, but sometimes also leaders in other industry, just to make sure that we can inspire them and show them what's feasible and possible out there. We then look at the risk, also opportunities, and we analyze the resiliency. We engage stakeholders, as I mentioned earlier already. So it's critical, like a plan will never work if we cannot get the buy-in from the top management. So quite early in the process, we want to make sure that we can have discussion with finance, operation, HR, to make sure that they understand that the company is working on that transition plan and that it does not remain just a theoretical document, but that it can really inspire the firm and help shape the strategy, including for M&A activities. Because too often we've seen companies that have really that are tracking all their risk, but then they make acquisition and they realize that they've acquired assets that were not managing those risks. And so, you can have, let's say, you take a industrial company, they have 20 sites. You look at every physical climate risk, you think that you're okay for the next 10, 15 years, but then you acquire sites that might be exposed to fire risk or flooding, and if it's not considered at the due diligence phase before an acquisition, that can, of course, create a lot of additional risk that could have negative consequences. Target setting. So most of our clients have typically already set targets, but it's really fine-tuning the roadmap and make sure that they have everything they need to achieve the intermediary milestones that they need to meet in order to achieve the target. And then finally, we work on drafting the transition plan, and we often conclude with what we could say forward-looking consideration or areas for improvement, identifying things that will need to be revised as technology and legislation evolve, because everything that we do is cutting edge and very often new. So we need to also be modest and understand that the plan is going to evolve as technology and legal requirements evolve as well. I'm now going to introduce our guest speaker, Frank. I want to say that I've been fortunate to meet several years ago when I moved to New York. Frank is also a fellow Belgian citizen. He's been in the US for much longer than I have been, and most importantly, he has 30 years of experience, mostly as an investment banker. So Frank was working for the largest Belgian bank during the latest financial crisis in 2008. And of course, he understands what it means to have to discuss with regulators and governments to try to save a bank when the situation is really dire. Frank is today a scholar at Middlebury College, where he teaches sustainable finance. He's also the founder and managing partner of Goose Creek Ventures. So in that capacity, he sits on different boards. And I should also mention that Frank, of course, has been an advisory board member of Agendi, I think, for almost 5 years. So he's really someone I'd like to discuss with when we face issues as we build the business. So at COP26 in Glasgow, Frank co-launched the Beyond Bretton Woods initiative, and you will see that this is going to be basically that's the framework upon which Frank built the presentation that he's going to give. So Frank, thank you very much for joining us today, and I'm pleased to give you.
Thank you so much. So welcome, good morning and good afternoon, or good evening, wherever you are. So it is an extreme pleasure to talk today about the trends and flows into international financial architecture. So can you click to apologize for some? Sorry. Yeah. Apologies for that. So my overarching objective here of today, talking about this international financial architecture, and especially some of the design flaws and our current pain points that exist, is to impart to you a better understanding of those kind of risk points, so that from a company perspective or corporate perspective, you can actually make adjustments and make sure that those bases are covered. Also assess those opportunities and maybe consider some solutions to address those issues. But also in a second point, give you sufficient material and insight and understanding of those current flows of the international financial architecture to become more engaged from a advocacy and a lobbying perspective to make the case in order to protect and defend the interest of your company and of the sector at large in which you're involved. So what I would love to do is walk you through some, in a very short format, some of the building blocks of our current international financial architecture. And I would love to kick off with the Bretton Woods Conference. It's a conference that took place in New Hampshire in the northeast of the US shortly after the Second World War, and there were some challenges to be addressed, rebuilding global trust, restarting trade, and stimulating growth. And there were about 3 major outcomes as a result of that treaty that was signed by about 44 member nations. First one was the establishment of the World Bank. Secondly was the creation of the International Monetary Fund, the IMF. And thirdly, the acceptance of the US dollar as a global reserve currency with gold convertibility. So what do these institutions actually cater to? So the first one, the World Bank, is trying to eradicate poverty and foster development. Secondly, the IMF was actually established in order to provide emergency loans in very often cases to alleviate some of the stresses that were triggered by balance of payment or balance of trade kind of problems. Next to it, it was also trying to monitor the global economy. And again, thirdly, this major element, I think this is, the change with the pre-war status, where the sterling, the British sterling, the British pound, was actually more of the global currency. So that's now been shifted and transferred to the dollar, with being backed by a certain amount of gold and convertible into gold up until the period of 1972 and 1973. Again, what have we seen since the emergence of the creation of, or the signing of the Bretton Woods Conference was actually, a whole slew of events that have taken place, right? So we have to start off with the Bretton Woods in 44-45, with about 2.3 billion, in world population, and a atmospheric CO2 footprint, so I think 310. So this is the amount of carbon dioxide that actually can be measured, and it's residing in our atmosphere as a result of the use of fossil fuel. And we see if we evolve to the right to the different events that have taken place. So we had the breakup of Bretton Woods in 1973 as a result of, the untenable position. There was too much money that was issued in the system, in the US dollar system. And as such, it was no longer tenable to support that convertibility into gold. We were moving to 320 weight. So still, I think, still there's a slight move in about less than 25 years. Then we had the fall of the Berlin Wall. For those people here in New York and the US, 9/11 happened in 2001. And we see gradually the CO2, atmospheric CO2 moving up to 370, right? So then we have the great financial crisis in 2008, COP21 that was already alluded to by Arnaud in Paris in 2015. And we gradually see this moving up, up to the 400 level and right up right now with after the Ukraine invasion. We're currently with 8 billion people. India is the largest country, or the country with the largest population as such, just overtook China. And we are at 423 atmospheric CO2. So these are some of the major kind of trends that have shaped the last 80 years, because next year we're actually celebrating the 80th anniversary of the Bretton Woods conference. So I would love to take some time to also see that apart from the architecture of putting in place this Bretton Woods, we also have 6 major trends that actually have influenced, the international financial architecture as we know it. And the first one was the free market doctrine. So this is what I would call the focus, or the singular focus, on profit maximization. No influence of the government, or as minimal as possible. No regulation. Try to move away from labor or trade unions. And definitely not, we're moving to the second point, embracing nature, or at least, taking into account the planetary boundaries. There was no room for that. So as I said, it was singular focus on the profit maximization element. Thirdly, it was undeniably that, the last 80 years we have seen, especially in the global north, and to some extent also in the global south, an improvement in the quality of life, in a sense, in the element of the extension of lifespan. But there is a paradox in the fact that we also see, especially in the global north, elements of addiction to, medicated drugs, but also to, of course, illegal drugs. And this has also had a major impact, the drug use and the amount of money that's involved in money laundering and impacting the financial system. We also have moved into major polarization. At the time of Bretton Woods, we had 2 major blocks. It was a block around the US, the Western Bloc, and we had on the other side, the Eastern Bloc around Russia. This has now shifted, with at least 3 blocks. We have China claiming or clamoring to become more prominent on the world stage, and the US and the global north, as the other bloc. But we also have a third bloc of more countries, some of them of terrorist nature, we call here, or we refer to North Korea and Iran. We have the element of globalization. Undeniably, I think, we have seen this promotion, or at least, the international financial architecture was also boosting, global trade. And then the last point was also dollarization. And this dollarization element is becoming somewhat of a threat and a challenge to especially China. So the dollar representing 20% of the real economy. If we look, the US as a whole is representing, or has a GDP of about 20 trillion. Overall, GDP is about 110 trillion, so 110 trillion in dollars. And yet it is representing, that dollar is representing more than 80% of financial transactions. So there's an element there of, unevenness or imbalance, which is, for a country like China, something that's very, very challenging. Now, I would love to take you to, apart from the design strategies, the design flaws, some of the major trends also into the multi-headed crisis. So some of those, or some of the people in the field call them the poly crisis. So we have this concurrence of about 10 major crisis moments. And the top 3 you might be familiar with, or I'm sure you are very familiar with: climate change, biodiversity loss, and the loss of food and water access. Underneath, you have the artificial intelligence and the data privacy issues. Artificial intelligence is the one that's dual colored because it has a dual capacity. It has the potential to actually be very nefarious, but it also has the potential, if applied smartly, to solve a lot of those issues that we see here in the poly crisis. I already mentioned the financial instability. I think we have actually still remnants of the 2008 financial crisis that are still inherent in our current system, but we also have the financial drag of actually having to finance COVID-19, and more about that later. The other elements, are speak for themselves: the geopolitical tensions, inequality, and social injustice. I just want to mention the inequality. So this is the 1%ers. So right now we have the 8 most wealthy people have more wealth than the bottom 4 billion on this earth. So this is a major kind of statistic, which is again not sustainable and not tenable. Right, so section 2 here is the current context. What actually are we facing? So if we look back, so this is almost like in the build-up to the 80 years, we have currently a major element of the climate acceleration. So I think, wherever you were this summer, you have seen some events that might have impacted yourself or some of your people that are very close to you. If we look at the recent trends, so we're now at 422 atmospheric CO2. We have an imminent collapse of the Atlantic meridional overturning circulation system, so which has to do with the jet stream, which is coming more to a halt. We have historic wildfires in different areas of the world, especially here in Canada, where smoke emanating from those wildfires actually impacted quality of life and triggered some air pollution in the city. We had severe floods in China, India, Slovenia, and Vermont. So unseen, waste level water in the capital of Vermont, Montpellier. So these are these elements. So coupling up or adding on, so this climate acceleration of those events, we are seeing that, unfortunately, there are a lot of risks that are priced for. So as you can imagine, and this is also what Agendi has been trying to do, is trying to guide clients in this field. But we have physical risk not accounted for, liability risk not accounted for, and transition risk not accounted for, and I say accounted for, but definitely not priced into the market. We have an end impact, in the real economy. So this is going to have impact on, the GDP, our global financial system, and especially the robustness and the vulnerability of the system, and also impacting the V20 countries. So this is a group of countries, the vulnerable 20 group, which now stands at 50 plus of the poorest nations. And here I'm not even mentioning, of course, I think should be a priority, the loss of life that is at stake as a result of the culmination of all these events here in the recent months. Okay, so we have as such this combination of the poly crisis with the accelerations of some of the climate events triggering some of those tipping points, right? So we have 15 tipping points, or to some extent 16 tipping points as identified by the Stockholm Resilience Center. And I just want to take out or pinpoint or zoom in about 2 major elements. We have the boreal permafrost, which is in the upper right-hand corner. If there would be a total defrost, there's a major reserve of methane. Methane, as some of you might know, is 26 times as powerful as CO2 emanating from fossil fuel. So the release of that methane gas is actually a major kind of threat, again, to the combination or the buildup of atmospheric CO2 in our system. The second element where I want to move to is the East Antarctica. And so this year or this summer, about 2.5 million square kilometers of ice sheet cover loss have been recorded. So this is an element scientists till this day have difficulty explaining or coming up with a sound scientific explanation, but it's a sheer fact. And as such, will impact water levels over and above, as already referenced, also the higher than normal water temperatures in the oceans, both at surface level and deep underneath or the bottom level of the ocean. Question here is also the Financial Stability Board, which is part of the IMF, should here, cooperate with the Sendai framework for disaster risk reduction. So this has been addressed in the build-up to 2015, but it's a framework which actually deserves much broader attention and which actually there's scope for collaboration and cooperation with the Financial Stability Board in order to bring those potential risks better in focus. Right, so where we are at this moment, I would love to consider and for you to, or at least submit to you all, a kind of theoretical case study. I think, imagine that we do have a major event, and I call this a 1 in 1,000 year combination of a wildfire and flooding event entailing $2 trillion in damages, along with the 1 million casualties. So I want to break down about 3 major domino effects. Imagine what would happen if the property and casualty companies are unable to settle the substantial number of claims. So the large insurance companies would face an extreme stress. Reinsurance companies, as part of the domino 2, would buckle under the weight of the claims from those P&C companies. So they would face collapse. And the insurance companies are extremely vulnerable to these climate calamity events, because there's both on the liability side, they are meeting enormous amount of liability claims, while on the asset side they face the domino effect of the investment of their investment portfolio and the quality thereof, and some of the impairments they have to absorb on their company. The third element is domino. The third domino is at least central banks have to intervene and inject a tremendous amount of liquidity into the financial system in order to maybe recapitalize or sometimes recapitalize some of those B&C companies and some of the reinsurance companies. But well, at the same time, we see that there is a stress in the system, because now you have supply chain disruption is causing what we call right now climateflation. So it is the price increases triggered by the stress on the food supply chain and imported goods. So there's an inability there to control that inflation that's triggered by these stresses as a result of the enormous amount of liquidity that's been injected into the system. Now, if you think that some of these elements are outlandish, I just want to give for some elements of magnitude. The 2004 Indian Ocean tsunami had at least, or triggered at least, unfortunately, 200,000 casualties. Total damages to date for the climate-related claims were about 270 billion. This is last year. And the 2000 financial crisis generated about 3.6 trillion in losses. So these are some numbers of magnitude and reference to actually consider a case study of about 2 trillion in damages and about 1 million casualties. So right now, what I would love to here consider for you is, and I know we don't have the ability to engage here in an interactive manner, but imagine that you're a central bank in the midst of this crisis. How would you manage this crisis, this magnitude of this crisis? How would you prevent the largest impact of such crisis occurrence? What are your priorities, and what are you missing most? Right. So these are elements where we talk about the adaptation. We're no longer talking about mitigation, right? So this is adaptation. So unfortunately, those events have crystallized. They've had the claims, the casualties are there. So what are you going to do from a central bank perspective in order to address these issues? So I'll share these with you on a rhetorical, basis. But I would invite you right now also to move in. You are a corporation, or you are a corporation. What could you consider? What should you consider? So here, are we still in a phase where we can address some elements and contributions to the mitigation? So first of all, there's the consider the TCFD framework. And this is the 2015 kind of framework that was launched on the occasion of the Paris Treaty by Michael Bloomberg. And it stands for the Task Force on the Climate Risk-Related Financial Disclosures, and to which Agendi is actually providing advice. So the next element is definitely assess scope 1, 2, and 3 exposure. So these are actually different elements of carbon footprint of the business that you're currently running. To what extent you have all those elements in there. And also this is in the prep up. So the TCFD has been a cornerstone foundational, for the formulation of the SEC climate risk disclosure rule, which is going to come out soon, and for which, all listed companies will have to comply with. The other element here to consider is stress test your physical transitional liability and counterparty risk exposure. So coming back on the element of an insurance company, to what extent do you have a exposure to a counterparty of which you have not yet fully assessed a climate calamity impact of that counterparty? To what extent is it crucial for your business? Is crucial for your management or your cash management position, not to talk about your solvency position. Next element to consider is to overlay your global climate physical risk maps with your supply chain and customer base. Right. So, what are some of the vulnerabilities? How can I reduce my vulnerabilities? And to what extent do I actually consider opportunities? What can I do in order maybe to provide a new service, new products that could be catered to, in order to have those issues addressed at core from a mitigation perspective? Last but not least, as Arnaud had alluded to, I want to come up to a pain point analysis. This is a busy kind of design sheet, but it's currently being looked at one of the central banks in the world. That's a major central bank, is being looked at. So because we have these 15 tipping points, and we have this acceleration of the climate change events. And as we've seen, there's about 4 major buckets. We have unpriced risks, we have non-adaptive responses, we have framing of value issues, and we have policies that are lacking in imagination and inspiration. So I want to focus on the unpriced risks. Where are they located? There's concentration risk, there's climate change. We have right now leverage. So this is total debt as a result of lending. So lending from banks and from what we call the shadow banking. So the shadow banking is the sector constituted of hedge funds and private equity firms. So that sector in itself has about 240 trillion in outstandings. And again, as I said, this is a non-regulated sector, right? So this is no supervision by a central bank, not a supervision of a regulator. They act on their own. And this is overall part of the 440 trillion. The difference is met by the banking sector, which is actually regulated. The 4 largest central banks still have 27 trillion on their balance sheet from quantitative economics. So this is money printed out of thin air. So I go back to Bretton Woods 1944, your dollar was backed by a certain amount of gold. Right now, we just have currency printed out of thin air to the tune of 27 trillion that's residing on the balance sheet of the 4 major central banks. Again, already mentioned, there's no climate change specific risks which have been captured in the system, and there's no systemic climate risk buffer. I want to move on to the float pricing tools. We still have not, we have in 2023 a total incapacity to come up with a unique, ubiquitous 24/7, 365 carbon price. So it would actually, we could envision a price that is linked to the development of the CO2 in the atmosphere. So we could actually set a price on that. When the World Bank looked at the global carbon prices that are in place, there's about as many different prices as there are carbon price or carbon tax systems in the area. So there's a definite need and maybe an opportunity for COP28 to identify and to come up at least with coordination to instigate and to launch and to support a minimum carbon price, which can be adjusted as a result of or as a function of the remaining carbon budget. There's also an element of ineffective monetary policy due to climate-inflation and price setting oligopolies. So we have 25 sectors that are now, economic sectors are run by the 4 to 5 top companies in their field, and they have the ability to actually, to set prices which actually become or make them immune from any price setting strategies from the central bank. I want to maybe move on to the right-hand side, the fallacy of the markets. We have had a pursuit of the extraction-oriented growth paradigm. So we're still focused on this growth paradigm. We're using GDP, where the greater the disaster, the greater the calamity, actually it is boosting GDP. So there's no adjustment, to make GDP reflective of the fact that we're in a crisis mode and that we're actually doing more harm than we're actually creating more added value. And so last but not least, I want to say, I've already mentioned in the policies, we have 7 trillion in oil and gas subsidies, right? So 7 trillion, 7,000 billion on an annual basis are being expended in order to support the oil and gas, which we have seen right now is very, very nefarious. It is nefarious from an inflationary perspective. It is nefarious from a health perspective, the air quality. It is nefarious, from our quality of life, and it's nefarious from the planetary or impacting on the planetary boundaries. Again, so why am I sharing this sheet is to get a better understanding of what these flaws are, right? So I think, where are you as a company facing these kind of unaddressed issues and pain points, and also give you the ability, not only for you as a corporation to address those vulnerabilities, seek opportunities to come up and design new products and services, but also, again, I can't stress enough, to make your voice heard in the advocacy process, because I think you as a corporation also reflect, and as a private citizen, you can also involve yourself as a private citizen, but you're entitled, to have your voice heard and address those issues in the interest of, avoidance of these major and further climate calamities. Last but not least, I want to cover some of COP28 major challenges. So this is going to be the first time in November, December of this year in Dubai that all the promises that have been made in 2015 at the Paris Treaty Agreement, there will be a global stock take. So these nationally determined contributions, again, jargoned word for the emissions that have actually been undertaken by each individual signatory country to reduce their carbon emissions, will be tested. And we know already from a preliminary exercise that, the outcome is going to be very debilitating. There's also going to be a push to phase out fossil fuels entirely. There's going to be pressure on oil and gas companies to reduce scope 1, so the methane emissions. And there's also commitments to double the energy efficiency, work on tripling the renewable energy capacity to about 11,000 gigawatts, and double hydrogen production to about 180 million tons a year. There's going to be also work being put into making sure that we have global the global early warning systems completed. And this is already a commitment from 2009 from the Copenhagen Treaty. So 2009, so more than 14 years from now. So rich countries to provide 100 billion a year to poor nations for adaptation. And here a hope is at least established that OPEC will come forward, given the largest wealth transfer that has taken place since the Ukraine crisis to the oil exporting countries, that they will actually be able to foot the bill of at least 100 billion in adaptation funds for the poorer countries among us. So, but again, as you can see, there is a COP28, no link to systemic risk of the global financial system. So with that, I conclude my talk, and I thank you for your attention, and now opening up to questions. So, Arnaud.
Yeah, thank you, joining you. Thank you, Frank. I think we had one question from the audience, Valerie.
Yes, it's actually a question that goes back to Arnaud's presentation, Frank. So if you allow me, Courtney is asking what Agendi's thoughts are regarding disclosing financial plans with the transition plan and what the recommendation is. Often this is commercially sensitive information, so the financial information is. So there's a challenge in understanding what information to disclose and how valuable that information is if it is too high level as part of that transition plan.
That's a really good question, and that's one that we face every year when we support our clients responding to the CDP survey, the CDP questionnaire. And I think it's really due to the voluntary nature of CDP. And I think my answer is that I'm really hopeful that the SEC release a climate disclosure rule that is comprehensive enough to include that type of reporting, because I think that those risks should not be hidden. Very often we see that because, of course, those unpriced risk that Frank alluded to, they are uncertain. You know, it's always like it's an order of magnitude. We know it's material, but we don't know the exact number. And very often the temptation is big for finance executive to hide that number until we have, you know, like a better model or until we have better assumption. So I think the only way to get the same level playing field and make sure that every corporation report is to have a mandatory framework. So for me, it would be in the US, probably the SEC, at least for listed companies. Of course, we understand that there are also more and more businesses that are going private, especially in polluting industries. That's a trend that Frank did not include in his presentation, but we see that a lot of polluting activities are being delisted, which is of course a risk. So the regulator will need to pay attention to that. And I'm also hopeful that, you know, the EU, the new EU, both corporate sustainability due diligence, but also CSRD will help us reveal those risks and make sure that it's not a choice for the company to disclose those risks, but it gets mandatory. I think it's also up to the investors ultimately to understand that those risks, even if they are estimated, risks that they will need to face. The issue is that, of course, many investors have a very short lens. You know, they look at the next quarter, maybe the next 2-3 years, but they don't consider risk when it's 5, 10, 15 years down the road. But we know that they are there and we're seeing them. So trying to build instruments that we need in order to account for the long term as well. I don't know if we have more questions for Frank, but I had one question on the Beyond Bretton Woods initiative. I was curious to know, like, are you getting momentum? Are there like policy makers that are part of the initiative, or what are the next big steps for the Beyond Bretton Woods initiative?
Yeah, so again, for those of you who might have missed the introduction, so I've co-founded Beyond Bretton Woods on the occasion of COP26 in Glasgow. And the initial kind of the think tank was, you know, gathering some momentum around ex-World Bankers, ex-IMF professionals, senior executives, but also some CSOs, so civil society organizations and academics, you know, who were actually trying to come up with proposals and recommendations to rethink this international financial architecture with its flaws and its design construction. So right now, to the point, so we found ourselves invited at the launch of the Bridgetown Initiative, so by Prime Minister Mia Mottley at the time. And so we have been somewhat in the slipstream of those of the Bridgetown Initiative, and actually have been able to cross over with current, or what we call the incumbency, both at the World Bank and at the IMF, where we can share, in the United Nations, where we can share some of the recommendations, where we can actually submit some of our proposals. And right now, so it is a very much, you know, a long-term kind of arc, because I think you could imagine that, you know, as a incumbency and on top with the polarization, some of those ideas are not always open for consideration. But we do see, again, central banks getting very interested in some of the ideas and some of the notions that are being brought forward, and also help them shape and design more innovative kind of strategies to address the challenges that the central banks are being faced with. So at the moment, we see the largest kind of attraction with central banks on some of these ideas, and to also consider policies whereby, in a smart way, we could consider and contribute to mitigation and adaptation.
Thank you, Frank. Valerie, do we have more questions from the audience? Otherwise,
And maybe we can go to the next slide so people know where to contact you.
And many of the mega trends that you show can be overwhelming when you take them at a firm level or at an individual level. How do you reconcile those issues with what an individual bank or an individual corporation can do and should do to mitigate those risks and seize opportunities?
Yes, I think it's a very good question. Oh, no, thank you. In my view, so this is an element where you've also alluded to the transition policies, right? So we have major transition strategies, at nation level, but also at the corporation level. And in my view, I think it is, absolutely essential and fundamental that as a corporation, you embrace those transition strategies. And in that regard, the Scope 3 analysis, which is the full supply chain, including your customer base analysis or review, is very, very important to see to what extent these megatrends, to what extent do they impact the supplier, do they impact a individual supplier, because he's based in a flood or wildfire-prone kind of area, but to what extent is your supplier also exposed to transition risk, right? So you just have to ask the German car makers how they currently feel about the fact that they're totally lagging in the electrical vehicle production compared to some of the Chinese corporates. So, I mean, this is a major kind of transition risk. And so if the car manufacturers would become part of your supply chain, this is a major element of risk assessment and risk identification that you need to address. And so in that regard, I would, even notwithstanding that this is maybe at the high level of risk level, that you look at microtrends. These macro trends need to be fully understood and need to be fully appropriated and incorporated within or integrated within your larger Scope 3 supply chain analysis. I mean, this is absolutely essential. And again, the only thing, even if people say, well, this is very cumbersome, it is very time, we don't have the time, we don't have the resource to do it. In my view, it is absolutely key. I would say even it would be, as a potential investor, I would say this is a negative point, because I think, in the future, how are you going to survive these stress? What's your ability to be stress tested in real life, against those potential risks that we have identified? Again, physical, liability, transition, and counterparty risk.
Perfect. Before asking my next question, I want to first say that Frank is going to respond in his own capacity, so he's not going to respond as Agendi, even if he's a member of our advisory board. And second, that Moody's is one of our clients. But I'm curious to know, like, we already have an infrastructure in place with Moody's, S&P, Fitch to analyze credit ratings. And I wanted to know, do you think that credit rating that would truly include climate systematic risk would be a solution? And if we push that to the extreme, does it mean that some entire sectors should be downgraded? Like, I'm always amazed to see companies that are really driving the climate crisis still enjoying really good ratings from a credit risk perspective. And I wanted to know what role you see for rating agencies.
Yeah, I think it's a very essential question about the role of rating agencies in this overall process. As I said, I will respond in my personal capacity here. I think it would be extremely beneficial if, for example, sovereign risk ratings would actually have a component of their rating attributed to the progress they're making on the NDCs. So we have 195 signatory countries that have actually signed up to the Paris Treaty in 2000.
Maybe defining NDCs for everyone.
Yes, NDCs were the nationally determined contributions. So this was every single nation's commitment to reduce greenhouse gas emissions, right? So, and the nations needed to identify, they needed to detail the individual actions they would undertake. It could be protecting, for example, part of the rainforest, or stop the deforestation of some parts, or it could be that they would invest in fossil fuel reduction and have, move and shift some of their economic exposure to the renewable energy part, right? So these are what we call NDCs. Again, it's jargon talk, and that's United Nations talk, for commitments at the nation level to reduce the greenhouse gas emissions. It could be a component as part of the sovereign risk if a country, let's say Madagascar, or if, for that level, Vietnam, would or could be identified as being very, very diligent in the progress they undertake in the reduction of their greenhouse gas emissions, and get a major contribution component where it would be a beneficial impact, on their overall risk rating. So this is a link we're missing. This is a initiative or an endeavor that we don't capture right now. And I will even give, an opposite or the paradox of this. 2 weeks ago, there was a census and a popular vote in Ecuador. So the popular vote actually voted against further oil and gas exploration in the Yasuni National Park, which is a rainforest. So ending oil and gas, and ultimately also this is an effort of a nation, to actually contribute to the improvement of the planetary boundaries. The next day, Moody's intervened and said that their credit rating would be on watch with potential downgrade. And so because an element there, so we see this paradox where a country might actually be undertaking to the benefit of us all, to the benefit of our planetary health and planetary boundaries, and yet the rating agencies introduce a certain intervention that actually might have a negative effect for the nation as a whole, and especially the cost of the debt at which they might borrow in the future. So we have this element. This is one of the major paradoxes that we have in the current system, right? So, and this is an element that needs to be brought forward and needs to be addressed.
Thank you, Frank. Valerie, do you have more questions? I keep asking questions. The EU is leading the charge on the taxonomy and also on carbon pricing. That's the only robust carbon pricing mechanism that we have today is the EU emission trading system. As a European citizen, I think Noah is also a US citizen. What platforms do you think would be the most effective at promoting transatlantic cooperation on those issues? And also, secondly, like how do we bring other regions, APAC, Latin America, Africa, who are extremely vulnerable? How do we bring them to frameworks that are being developed in the EU and potentially inspiring the Anglo-Saxon world as well?
Yes. So you're right. And again, we're biased as Europeans here, but I mean, Europe actually has been really leading into the introduction of the compliance market. So the compliance market is a market that's cap and trade is another word that's being used. So the EU has set a ceiling of carbon emissions that is allowed by sector, and it's actually addressed towards the most polluting sectors, including steel. So, and there the industry and the individual companies are actually compelled to undertake action to be or stay below that ceiling. And if they can't, they actually are compelled to buy rights from their competitors and more efficient kind of operators. So it's a very, very neat nudging system that's been put in place, and that actually has actually been executed without too much inflationary pressure that has been triggered by the system. Now, this is an element. The EU has a rule book, an outstanding rule book for implementation by any country. So it's about 50-page handbook that you can find on their website. And so every nation has the ability to just, borrow and steal and execute it to its best intent. So I want to refer also to the, when you say what would be a platform. So the EU, in my view, is not monetizing sufficiently this kind of knowledge they have in the field of a cap and trade introduction on greenhouse gas emissions. But there's an Article 6 in the Paris Treaty, so without becoming too technical, Article 6 allows actually for the sharing of this kind of expertise and actually spreading the notion of a carbon market. And so when I say carbon market, this is a compliance market. This is a very, very tightly run and monitored kind of carbon market. And so it could be ultimately an inspiration for the voluntary carbon market. So this is the opposite. So these are individual efforts in order to safeguard some of our carbon reserve. And there's an element here is an opportunity to create and some efforts are underway, by the way. So there was the Africa Summit last week that was trying to promote some of those notions. But we can imagine, or you can envision, that once you have unique, ubiquitous 365, 24/7 carbon price, that price could be referenced onto the voluntary carbon market. So the voluntary carbon market would actually be driven by the price signaling effect of that compliance market. And that's something, again, where I see an opportunity for the EU to be more leading and to be more visionary onto the global stage.
Yeah. Knowing that the current compliance price is close to $100, so very different from what we see on the voluntary market. So that would bring the capital that we need. I think we are already past the time, so I want to thank our audience to stay with us. And if you want to reach out to Frank, you can connect with him on LinkedIn. You have also my email address if you want to continue the conversation. Thank you very much for your attention today.
Thank you all.
Bye-bye.
Bye-bye.